Hi guys, welcome back to another quick and a short video. It's probably like a follow-up to the video that I posted on the channel warning you guys about trading in December, the things that you need to be careful of. I think I pointed out that the big guys are most likely going to be going on holiday wherever they go on holiday, so they are not going to be trading maybe around about from the 10th of December to around about the 15th of January 2023 when things will start picking up again. So what does that mean when the big guys, the hedge funds, the big banks, the big institutions are not in the market? We are going to see then low volatility, low volumes in trading. And in this video I'm just going to try and explain why it's bad for you. If you are new on this channel, please consider subscribing so that you don't miss any of our future videos. Go ahead and like the video. See the links in the description box below if you also want to try our forex robots, our indicators, our books, the courses that we are sharing for free. We are sharing everything for free on this channel. You get everything for free, so see the links in the description box below. Now coming back to the topic of the video, why is low volatility and low volumes bad for you? In case by the way, the market is going to be open Mondays to Fridays until whatever. The market is open Mondays to Friday, but the warning that I'm just giving you is just to be careful, because there's going to be low volumes and low volatilities if the big guys are on holiday. Now the danger of low volatility and low volumes in the market, first of all, is that one, you are not going to have the guys that move the markets playing in the markets. Like I said, they're going to be away on holiday, so it means anybody with just a good amount of money in their pocket can move the market whatever direction they want to move it. So it's very easy for somebody to spike the market and take you out of your position, or maybe even give you some money if they happen to move the market in your direction. But it's rather going to be like unpredictable, so you're probably not going to want to set very tight stops, or you don't want to set long trades, very long trades, long-term trades, and you want to avoid very tight stops, because the market can be spiked anyhow by anybody with who can just master a good amount of money to move the markets, because the guys that we usually rely on to be moving the markets are going to be away on holiday, enjoying their Christmas and holidays, spending their bonuses and stuff like that. So that's one of the dangers of low volatility, low volumes. Now we rely of course on volatility and volumes to quickly get us to our TPs. Now if there is no movement in the market, then it's going to be a very long time where between placing a trade and actually seeing that trade pan out. You get the sense. We need volume in the market, we need volatility in the market. If you have volume in the market and volatility in the market, that's when you see you can place let's say a buy here and you get filled here. By the way, this is a system that I use. I've done a video, I think several videos on this channel showing you how I use my system, and if you want to download it, I think I've also shared the links for downloading this system on this channel, so go ahead and watch those videos. So it's very easy if you have enough of volatility and volumes in the market to come and buy at this level here and expect to be filled around this level here, easy peasy. But if there is no movement in the market, there is no volatility, there is no volume, I promise you it can take ages. it can take ages for you to come actually to reach this point, because there's just no movement. Nobody is buying, nobody is selling, so it's going to take a long time for you to see this movement. So if you're probably going to want to be trading this festive season, and periods of low volatility is something that you need to be mindful of, maybe instead of aiming for this huge movement, just take your bits and pieces as they come, and get out of the market. And again, like I said, you don't want to be holding long-term trades. You don't know which way the market is going to go after all, because we said the big guys are out of the market, they are on holiday. Now it's just guys who are just moving the market. Now, what you also know about low volatility is the danger that comes. Let's go to here. I'll just try to show you this using exotic pairs. I'm going to use exotic pairs as an example, because exotic pairs generally don't see volume and volatility. Let's look for an exotic pair. I think this is an exotic pair. US dollar versus Singapore dollar. Sure. Polish zloty. Let's just show that. South Africa rand is an exotic pair, but it tends to move. I'm talking about pairs like this one, US dollar versus, I think it's Chinese ren. I don't know if it's a Chinese renminbi or if it's the Russian what, I don't know, Hungarian forint. I've never traded that. Okay, so you will see in terms of spread, that's the danger of also low volatility. You find that because there is low volatility, my MT4 on MacOS doesn't want to cooperate. That's one of the things that I discovered when using MetaTrader 4 on macOS, that sometimes it lags. I don't know if it's my iMac or if it's the particular OS that I have. It's High Sierra that's lagging, I don't know, but in any case. So here is what you would observe. This is spread. This block is a spread. Now it responds. This block is spread. So we already know Euro USD always sees high volumes. That's why you see the spread is actually less than 2 pips. Spread. The spread is in points, by the way. So here it's less than 2 pips. This is the DXY. I've told you how I trade with the DXY on this channel, so I'm not going to go into that. You don't trade the particular dollar index. You don't trade dollar index, but you can use it as a gauge for the US dollar. But watch the videos on this channel. I explain everything in there. So yeah, so you can see here on Euro USD, the spread is less than 2 pips. Why? Because Euro USD always sees huge amounts of volume and volatility on any given trading day. Same with GBP USD, is around about 2 pips. USD JPY is around 2 pips. Gold is around about, let's just say 3 or 4 pips, but let's just say 3 pips. That's the spread on there. The effect of low volatility is the widening of spread. Low volatility means wide spreads. This is what we see here. This is US dollar versus Hungarian Florinta, whatever. I don't know if I'm pronouncing it well. Forgive me if I'm not pronouncing it well. But you can see the spread there is 44 pips. 44 pips. That's the spread on if you're going to trade US dollar versus Hungarian Florinta. The rand, the US dollar versus rand is almost okay, because it's basically a 15 pip spread. Let's see if I can put it on my chart. It's basically almost a 15 pip spread. Let's go to properties and show ask line. That's the spread there. You can see the spread if you're going to be trading if you're going to be trading US dollar versus the South African rand. That's the spread that you're dealing with. So you are going to place a trade, and you're going to wait a long time before you actually get into profit. That's the danger of trading with low volatility and low volumes. That's why I said be careful this time of the year. If you're going to be trading this time of the year, here we have actually 39 pip spread. It's US dollar versus Polish whatever. Here is 20 pips spread. That's US dollar versus Singapore dollar. This is crypto. This is 29 pips spread on Ethereum versus US dollar. BTC versus US dollar, we have a spread of around about 300 pips, but that's crypto. So you need to mind this, because this is going to determine in the end of the day if you're going to be making money or if you're not going to be making money at the end of the day. Because if the spread is so wide as it is here, you actually need that pair to move a long way before you can actually, your position that is actually if you're going to place a buy, where does it appear? It probably is going to appear there. We are going to need a lot of movement in this pair before price can get above here, because of this wide spread here. So that's the danger of low volatility for traders, and it's going to be you probably are going to see wide spreads as we inch towards Christmas, because the result of low volatility and low volumes. So I just had to explain that in this quick and short video. If you have any more questions, leave them in the comment section below and I'll try my best to answer them. Otherwise, guys, subscribe, like the video, see the links in the description box below. I'll see you in the next one. Bye.